So this data here should remind you of the data set that we were looking at when I introduced statistics, the statistics review. And here you have information on a broad index that is intended to reflect the performance of the economy by estimating or by using the returns, the combined returns in an index of 500 top performing stock. And the 500 change from time to time, but they're combined in a way and tracked, and you can actually invest in something like an S&P 500 index or a Dow Jones index and track the, earn the returns like the market does. Now that's quite risky, as we explained, as I showed you. However, on average, we saw that you can get about 11% return. So here, this is showing you that when there's a good state of the economy, the S&P returns are 18. Here's a firm, BCE's returns are 26%. And we talked about how to estimate these numbers. And I've only given you 2 states of the world, only 2 possibilities, right? In general, when we want to calculate the slope from the least squares regression line of observations, we have that formula that I mentioned to you, RSY over SX. In this case, there are only 2 observations. So we could just calculate the slope as change in Y over change in X. Just 2 values. So investors are able to, so the theory proposes that investors at little cost can just pick a set of assets large enough that they've taken advantage of the diversification effect. But beyond that, to reduce or to control the riskiness, they'd have to care about the non-diversifiable or systematic market risk. Now, market risk per security is measured by the beta. Remember, the beta is a measure of the sensitivity of returns to market changes. So in this case, you can calculate the beta. You have 2 observations or 2 values. And you can calculate, you don't need the slope, but we want the slope of the imagined line between those points. So what is the slope of that line? Is positive? Yeah, what's the value of it? So we calculate slope for 2 values as, I can write it like this. And the change in Y, if I was going from the bottom up, the change in Y is from 26%. I'm going to put it down here. Okay, so that will be 30.3 divided by 0.12, which turns out to be 2.5. And this is an index, it's not a percentage. So what does it mean? How do we interpret beta. Following a change of 1%. So take it like this. So change in Y over change in X. For an additional unit of change in X. So in other words, a positive 1% increase in the market return will be associated with a return in BC by 2.5%. So for each unit change in the market returns, BC returns will change 2.5. That sounds good and well and awesome when the market does well, but possibly if this relationship holds true down here, when the market does poorly, that could also mean a loss or a negative return over a period in the market could result in a negative return, or it's associated with a negative return of 2.5. It's amplified for BCE. So, in fact, this is a positive relationship, but just as well when BCE has when the markets have negative returns, BCE has negative returns and amplified negative returns. So here in this case, beta is positive, but beta can also be negative. What would be an example of a firm with a negative beta? What would be what would describe what is beta? So beta is the sensitivity of a firm's returns to market returns. So what kind of industry or firm is going to be negatively correlated with market returns? So when the market does well, this asset does poorly. What would it be? Do you know? When the market does well, the industry gas, when the market does well, gas is negatively correlated, or energy is negatively correlated. What else do you guys say? Yeah, it's not common. I'm just looking up because it's an interesting proposition, but I don't think that's an easy thing to say. Clear cut. It can be, but I don't think it's a clear thing to say. I'm reading an article that says oil stocks negatively correlated to market first time since, I guess, in 2 decades. So it can be, but it's not necessarily. So when the market does well, this asset does poorly, or this type of asset does poorly, or if the market does poorly, this type of asset. So what do people go to when the market does poorly, when the economy is in recession, when the economy is in depression? Right, you got it. So it's gold. So gold and all aspects of gold, the gold industry. So there are funds that invest in precious metal companies, either companies that are extracting gold or mining, or research companies, or companies that create securitization. So they create bundles of precious metals that you can invest in, or the gold index you can invest in. So, precious metals, gold, silver. I haven't heard a lot about platinum, but platinum. What's another one lately that, I guess, in the last decade or so, when the market does poorly, where do people go? Crypto, very good, okay. All right, so that's just an example. So those are negatively correlated. Okay, so here we are. We're going to talk about the market portfolio. So the market portfolio is a portfolio of all assets in the economy. So they're all held in some proportion relative to their market capitalization, like their value, their outstanding value in the broader economy. In practice, a broad stock market index such as the S&P 500 is used to represent the market portfolio. Beta is the sensitivity of a stock's returns to the return on the market portfolio. And even though I keep trying to remind you of the simpler formula for the slope, we're going to graduate or elevate to the Greek letters, but it's the same idea, right? This is where I is on the y-axis. You have the firm. And on the x-axis, we always put the market. And so this is the equivalent formula. That's R. The rho is the Greek letter for R, rho, it's called. And then SY would be the standard deviation of the firm's returns. And SX would be the market. And similarly, we can make a substitution. We can put this as the covariance to introduce the covariance, put the correlation substitution in here, and you'll see that this term here, the standard deviation of I, cancels with this one, and you're left with this term for beta, which reflects that it is spreading out the covariance per unit of the market, the variance of the market returns. That's the beta sensitivity. Beta is the sensitivity of stock market returns to the market portfolio. So this is another interpretation. This is a formula that I'll use as well as the other one, because sometimes it's just easier to calculate 2 statistics rather than 3, like in this case here. All right, so let me take one moment to see. I want to check something before I continue. All right. Okay, so we have arrived at Markowitz portfolio theory. And we're going to again discuss our formula for variance of the portfolio, where the portfolio is the weighted returns, right? The returns are a weighted sum of returns. And I'm going to make that substitution I just discussed, but I'm going to do it in a different way. I'm going to substitute out covariance for this amount. And why do I do that again? Because I like correlation, because correlation is bounded. Correlation is between -1 and 1, and it makes it easy to do what I'm going to do next. Okay, so I'm going to substitute this term from the definition of correlation into here, and now I have my variance as a formula with correlation. So here's two assets. We see that the risk-return trade-off exists between them. Y is higher return, but also a higher risk asset than Z. So I can plot those here with this is the standard deviation of the portfolio here, and here's the expected return. And if I put %100 of my investment in Y, let me do it a different way. Let me write it like this. So if I have the weight for Y at 1 or 100%, then the weight for Z is at 0. So it's all Y. Then the portfolio will all be invested in Y, so the mean and standard deviation of Y are the portfolio's mean and standard deviation. Similarly for Z, this point here is 100% invested in Z, but nothing invested in Y. Now, so that's just Z, and that's Y. So Y is higher return than Z, but also higher risk than Z. Now we're going to consider all possible combinations of Y and Z, where I start with Z and add a little bit of Y in as I go. Now I've drawn out 3 different scenarios. And I've done that because although the expected return calculation doesn't have anything to do with standard deviation, it's just the expected return values weighed. So here's a formula for the expected return. And I allowed the weights to be selected by you. So which are the weights that you want? Which weights would you like? That's the question. So that's what should mostly depend on risk tolerance, okay? Risk tolerance will determine the expected return and with consideration for the risk. Now here's the formula for standard deviation, but I've done that substitution that I mentioned to substitute away the covariance term. And simplifying, this is my expression that I get, and there's an extra term in there. I think I fixed your notes. Let me double check that I fixed your notes to include the extra term. I don't know, maybe I didn't put it in there yet. Anyway, it just something, oh yeah, see, I said new. portfolio new. I might still have to type. Yeah, okay. So I still have to add that because I just noticed it's not a big deal, but in here is also multiplied. So it has to be to the weights, which are here, and then the standard deviations. Now the standard deviation of y is this amount, and then the z, I have to multiply that in as well. I'll see if I get that edited, but you should make a note about that. So this formula is the return, and this formula here is the standard deviation, and it generates for different combinations of C and Y, it generates this map here, this graph, this chart. Well, it's a graph, I guess. And so if we start here with 100% in Z and nothing invested in Y, and then we consider adding some Y, we can move up I'm not going to put the number, but so this has more of Y in it than 0. And we start moving up. Now, notice here, I've used this line, but there's also, I have this one and this one. The division of the, the separation of these 3 different drawings is by the assumption of what the correlation is. If correlation is -1, it turns out that you get these sets of combinations. Okay, so this set of combinations are here. If the correlation was 0, you would have this middle one. And if the correlation was perfectly positively 1, you would have this outside one. So what does it show? If the correlation is perfectly negative, you can achieve this. What is this position here? What's the good thing about this position? Or this choice in weights? How do you characterize this combination of weights? You've completely eliminated risk if you can find this combination here. So how could you find it with the information I've given you here? How could you find those weights? So you could do this in Excel. You can make a formula. You can have a whole list of combination of weights and use them in the formula and plot a chart. You could do that. If you wanted to see what if the standard deviation is 0, what would be the weights? You could see it in your drawing or approximate it in a drawing, or you could solve this expression. Here's one equation. So you'd have to say, given if you believe that they were perfectly negatively correlated, and the weights sum to 1. What you would do is set the left-hand side to 0 to solve for the minimum variance portfolio. And that's this one here. Okay, so you might want to do that because that will tell you where the possible combinations are that investors would choose between. Because in fact, none of these down here would be rational combinations. Can someone explain to me why? What is the goal? The goal is to have a high return with a low risk, right? I mean, that, I don't know if that's a goal, but that's a dominant strategy. Let's call it by its name. Let's do that again. It's a dominant strategy. High return, low risk. So if I'm here 100% invested in Z, what is stopping me from mixing a little bit of Y? Well, nothing, because I will have a lower risk and a higher return by just adding in Y. If it doesn't cost anything, so we assume 0 transactions cost, there's no cost of mixing these together, okay? So then I have to calculate that in. So I'll assume there are no transactions costs doing it. And so choosing to put a little bit of Y in will increase my return and lower my risk. So I'm going to do it. And I'm going to do it all the way up until here. So that's why you want to know what is the best you can do in reducing the risk. And then these combinations are trade-off. There's a trade-off in here. And the way that someone chooses is according to their risk tolerance, what kind of risk they're prepared to take. So these are the efficient options here. So, well, no investor will oppose doing this because this is rational. Okay, if you didn't do this, you would be irrational. It would be an irrational choice, or you just can't do the math. But we always assume people can do the math. Assume investors can do the math, and none of these would be feasible combinations. The goal is a high return, low risk. The reason why I changed the word from goal is because, well, I kind of contradict myself, because then I say you're willing to take risk according to your risk tolerance. So I didn't want to contradict myself. So choosing the proper combination is dependent on, or the choice of the combination here depends on the preparedness of investors to take on risk to obtain that return. So all that I just talked about was about correlation equal -1. Now that's not only going to be the case that you can completely eliminate risk if the correlation is perfectly -1, and you need to find the combination to do that. If the correlation is 0, then you can't diversify at all. Mixing doesn't remove risk. You actually have to remember this is the case where each asset, the formula for the case where they're perfectly or they're not correlated at all, reduces to, where did I put it? This formula here. I can't put it. Oh well, anyway, so that's the formula. So what happens is you have the same thing, okay? So this little stretch here, it will not change the measure of risk if you add a little bit more of Y in. So the decisions for these investors starts here. So yeah, I'll put that, I'm going to put a green circle around it or something. So that's the minimum variance portfolio there. This is not a minimum variance portfolio, but it is the, this has the same variance or standard deviation, but with a little bit of Y, you're increasing return. So none of the assets between there and there, I can't make it that thick, I gotta thin it out, will exist. So same argument as these, oh no. Same argument as for these ones as this set here. So the efficient options begin here, the feasible options begin here. And then there is no clear decision between any of Z and Y, any of the combination between Z and Y along the linear combination of them when the correlation is a positive one. It's all a trade-off all along. So let's look at a few different combinations. So I've done a few calculations here and I've marked them. So let's look at this one here for expected return. Okay, so if you look across here, I have three different combinations I'm proposing. Portfolio 1 has 75% of Z in it and 75% of Y in it and 25% of Z in it. So this is closer to Y, right? It's more Y in it. And out of all the combination that has, so then there's these other options here. So in this portfolio set of weights, my return, expected return is the highest of the three, 18.6. So that's over here. And it hits each of those different, the different options or the different possibilities of the correlation. I've marked them in yellow. So the correlation, if correlation is -1, the expected return will be 18.6, but the standard deviation will be here. What will it be? If you plug it in the formula, you will find that it's 7.38. So this would be 7.38%. This is the combination where the correlation is 0 and you get 7.69. Let's see, 7.69. And then where the combination is +1, you should get 7.98. So this one will be 7.98. So that's how you read this chart. So these are all, you could compute all of these. Okay, and that's what the chart is showing. So the best you can do in return out of the ones on the table, 75% Y is 18.6, and then it's a matter of what is the correlation. You can't choose the correlation. You can just choose the combination of weights. Combination or weights. So, do you want me to do another one, or can you understand this chart now? So just be clear that what I've done here is shown you the limits, sort of the limits of what's possible. So whatever assets you look at, one is low risk but low return, one is high risk and high return. Depending on the correlation, you'll get a range of possibilities. So really, because the correlation is very unlikely to be perfectly -1 or very unlikely to be perfectly +1, rather you'll get something that comes in between those two. So this curve represents all possible combinations of a high risk, high return asset and a low risk, low return asset. Okay, so this shows you that this is known as the diversification effect that I've discussed. So I'll just say this is the diversification effect, that all of these combinations won't be chosen because they're not efficient. You'd start somewhere like that in choosing between the alternative combinations. And the efficient set is all these here. All right, so what I've looked at are 2 assets at a time. And their combination in a portfolio. And I've described that the expected return and standard deviation will vary given different weighted combinations of the 2 stocks. The feasible set is the entire set of options but the efficient set starts at the minimum variance portfolio. Okay. And that's that. So it would be important to find out what that is. What if you have more than two assets? In fact, people hold more than two assets. I already described that a portfolio with up to 25 randomly chosen assets can succeed in lowering risk substantially. So what if there were more assets, right? What we imagine are the same eggshell shape between two assets. And what I've done here is I've put them all together in the same expected return of the portfolio and risk space. Can you hear me all right? Okay, so what we imagine here, you see this one here. So if we had two assets, X and Y, and then here, D and E, then we consider, how do we look at all these assets? What is our goal? What is it that we want to do? We want to reduce risk, so we want to move left, and we also want to increase return. So given all these combinations, it looks like the best set of assets would be, if that's all the possible assets and I consider them two at a time, then the best combination of them would be on the outer edge of all of them. So the feasible set of assets in a portfolio is all these on the outer envelope, but all those inside as well. Those are all possible. But with the same logic, investors will only choose on this envelope because this achieves the best set of lowering risk, but increasing return and leaving you with that trade-off. Anything below this minimum variance portfolio, any combination down here would not be chosen for the logic that I used before, because you could always improve up until the minimum variance portfolio. So which one we choose is what we want to talk about next. So the one that we choose would represent the market portfolio of the portfolio of risky assets. We assume that investors are rational, that is, they prefer more to less, and they are risk averse. So if you're trying to decide between assets, you can use this quick visual tool. Imagine asset A Right, Eileen. So There is no best option. It depends on a person's desired risk level. So out of these options that I mentioned, from the minimum variance portfolio out, it depends on what you're prepared to take in terms of risk, okay? But we've ruled out at least some of them. We've ruled out all those inside and the ones down here. All right, so looking here, which assets are dominated by A? Dominated by A. So A, if I've drawn a grid through A, or I put A in the position where the grid is, and I look and say, well, A is clearly up and to the left of what? Everything in this lower quadrant. So B and G. Okay, so A is left up and to the left of B and G. Not F, because F, although F is lower risk, it's also lower return. So we like, we like the low risk. It's hard to decide in that case. It's not a clear, between A and G, A is better, right? Because it's higher, it's the same risk, but higher return. It's a clear decision. Remember that discussion of the coefficient of variation. We had to divide risk by return to be able to say something. And in this case, the clear-cut domination or dominance is A over G and B. Let's do another one. So what about C? What does C dominate? What does C dominate? Just B, Luis. Yes, just B. Only B. You just draw the grid through it and C is up and to the left of B. You can do this if you just make the grid. So what about D? There you go. A, B, and G. Correct. Okay. So you understand dominance. So what we're going to do next is we've talked about choosing between risky assets. I've created a model here on how you can rule out a whole bunch of combinations, but then you're left with choosing between a whole set of remaining set of combinations where the trade-off is alive and well. And where you end up there depends on your risk tolerance. So that's just risky assets. But as we discussed earlier, rational investors who want to beat inflation will invest in the risk-free assets. So I'm going to combine now the risky assets and as a portfolio of risky assets, and I'm going to combine choosing to hold the risk-free asset and the portfolio of risky assets. And now how are we going to do that? Right. So that is the question. So to do that, I need to talk about short selling. Short selling. Did we talk about short selling before? Does anybody know what short selling is? Now, the idea why I'm presenting this is I want to introduce to this model is our approach is to arrive at the capital asset pricing model. And I've just described portfolio of risky assets. And I want to get to the point where I use the information about the portfolio of risky asset that mimics the economy to help me decide on pricing assets. And in other words, finding the expected return on assets. That was my objective of teaching you all this and going back into statistics. I want to be able to show you how we can use our understanding of risk and return to appropriately estimate the cost of capital, the expected return for investors in stock of a company. So for this model, I've only talked about risky assets so far, but now I want to introduce the idea of risk-free asset. And the model depends on being able to both invest in the risk-free asset, but then also to leverage the risk-free asset. If you remember way back in one of the first classes, I talked about leverage and being able to borrow against what's you're borrowing against what you anticipate getting. Okay, so you can do this with a T-bill in the following way. You can short sell. So short selling by definition is the sale of a security that the investor does not own. So you can borrow, if you can make an arrangement with a broker, investors can borrow a security, if finding a broker who's willing to do that, and then turn around and sell it in the market for its market value, then use the proceeds for whatever it is they want to use it for. In this case, we're going to use the proceeds of a sale of a a borrowed T-bill, a shorted T-bill. We're going to use the proceeds and invest in the market portfolio. Okay, that's what we're going to do with the money. And then when it comes time to return the borrowed T-bill, the investor has to buy it on the open market to return it to the broker. That's the process. Now, you might have heard about short selling in the context of short selling assets. And the idea there is, if you believe, contrary to what someone selling you the asset believes, you believe that a firm is in trouble and the stock is going to drop, or the stock value consequently is going to drop, you can short sell that asset, make an arrangement with a broker, borrow the asset, and then return it at a later date. The later date, when you have to buy it in the market to return it, the price will have fallen. And taking advantage of that, you can realize a profit depending on what you did with the sale of the asset and using the proceeds and what you did with those proceeds and how successful you were. So in this context, though, all I'm going to do is use it to generate or create a borrowing mechanism. Okay, so I haven't assumed that there's banks per se. I'm just talking about risky assets in the market, and then the risk-free one, which initiates borrowing and lending at a risk-free rate. All right, so going through this, the definition of a short sell is the sale of a security that the investor does not own. How does it happen? You borrow the security from your broker and sell it in the open market. The cash flow is the proceeds from selling the security. To close the short, eventually you will have to buy the security back in order to return it to your broker. At the elimination of the short sale, your only cash flow is the price you have to pay for the security in the open market. Okay, let's put some numbers on that. Let's do this with treasury bills. So a T-bill is a zero coupon bond issued by the government with a face value of $100 and with a maturity no longer than 1 year. If the yield on a 1-year T-bill is 5%, then its current price is $95.24. So you know this because there's zero coupons. It's just a pure discount bond. So let's look at the short sell. You can borrow the 1-year T-bill from your broker and sell it on the open market for $95.24. So the cash flow is the $95.24. To close the short at the end of the year, you have to buy back the T-bill an instant before it matures in order to return it to the broker. It'll cost $100 to do that. So you borrowed $95.24 essentially for 1 year, and you paid it back at the end of the year for $100 and paid 5% for that interest. And what you're banking on is that you're going to make a higher return than that by investing those proceeds in the market portfolio. As I said before, the market portfolio return on average has been historically about 11%. So you're banking on doing better than that. Now, that's not without risk. Okay, so now let's see. Let's put this together. So we've assumed that lending and borrowing can take place at the risk-free rate. Here I've plotted the standard deviation of the portfolio as a measure of risk, the expected return of the portfolio as a measure of return, and I plot here the risk-free rate. So the risk-free rate is lower than the market portfolio. Lower risk assets, as we explained before, have lower returns, so that would be about here. And what we're going to do is imagine all possible combinations between the risk-free rate and the market portfolio. The market portfolio I choose out of all the risky assets set here is going to be the one that lies just tangent to this set of combinations. So when I make a line, I'm going to touch right here. And this set of assets that I touch, so there's a little bit, theoretically we say there's a little bit of every asset in the market portfolio. And now we have the risk-free asset, the market portfolio, and we introduce the possibility of holding them in a combination. So I'm going to hold T-bills. When I hold T-bills, I'm lending money to the government. So I'm going to hold T-bills, and I'm also going to purchase, I'm going to invest in the market portfolio. And I'm going to put myself here. This is partially invested in the risk-free asset, so I'm loaning the government money at the risk-free rate. and I'm partly invested in the market portfolio. And let's say I'm happy with this level of the standard deviation, so this is where I end up. This is the combination I choose, A. Now you might be more of a risk taker, so you want to do this, B. What's B? B is a combination of investing in the market portfolio, but short selling T-bills to put myself beyond the market portfolio. It's a very high risk combination, but it's also a high return. This line here is known as the capital market line, and it is the new efficient frontier. Investors choose where they want to be on this line depending on their risk tolerance. Questions so far? I know it's kind of hard to ask a question, but you follow me so far? So all assets, all risky assets are in M in some combination. And A and B and all the other alternatives between are some combination of the risk-free and the risky assets. So all securities are in M, and all investors have M in their portfolios since they are all on the new efficient frontier, the CML. And they're investing in both the risk-free rate or the risk-free T-bills and the market portfolio. Therefore, investors are only concerned with the expected return on the market portfolio and its standard deviation, and with the contribution of each security to the market portfolio in terms of its contribution of systematic risk and its contribution of expected return. What I'm going to do next is take this trade-off between risk and return and now substitute, instead of looking at the portfolio, I'm going to look at each asset's expected return. And I'm going to put its risk here. So all I've done is I've changed the axis for risk. And return, and I'm doing it for each individual asset one at a time. This is the capital asset pricing model. It's actually a line called the SML, the security market line, and it looks like the CML, but I've put on different axes so it gets a different name. It's a line. The y-intercept is the risk-free rate. And the risk-free rate plots with a beta of 0, right? So it falls right here. Similarly here on this CML, the standard deviation of a portfolio invested, oh, I should put it as F. A portfolio made up completely of T-bills would have a standard deviation of 0, just like the T-bills standard deviation. All right, so here is my line. This is the y-intercept. What is the slope of this line? what is the slope of this line? What is the slope of this line? It's a positive slope, but what's the value of it? Not just the strength. I mean, not just the sign. What is the value? Okay, not one, but I see where you're going with this, Julio. All right, let's look at this together. Okay, first of all, this is the risk-free rate. And remember my discussion with you that rational investors, everyone will invest, all rational investors will invest in T-bills. So the expected return to any asset should exceed the T-bills return. And remember the discussion that we had about that, and I was talking about risk premium, right? That to hold risky assets, the investors have to be incentivized, and I calculated a risk premium by subtracting the expected return to an asset class by the expected return to T-bills. So what is this amount here? What is this called?
La prima.
Yes, good. Okay, so I led you into the right direction, but it's a specific premium. Which one? So we calculated the risk premium for different asset classes, but this one is which asset class? I'll just tell you because it's going to be confusing. It's called the market risk premium, right? So I'm using that specific, the expected return to the market portfolio, the market risk premium. That's how we're going to recall it. So you guys did well. At least 4 of you, 3 or 4 of you got the idea. So this is called the market risk premium. I'm very happy that you got it. So this is the market risk premium. Okay, now I'm going to ask you the question. What's the slope? Again. You guys have it like in pieces. What's the slope? Let's do it together. Let's do it together. Let's do change. Let's go between RF and M. So the change in X and the change in Y. What's the change in X? Going from this point to here, what is the change in X? Great, 1. Right, the change in X is 1. And what's the change in Y? Again, going from the risk-free rate to the market portfolio, what's the change? You see that? The change is, so if I'm going to go from here to here, I move 1 over, that's true. And I move how much up? ERM minus RF. Yes, the market risk premium. Excellent. By name, Luis. Very good. So the market risk premium over 1 is the slope. So there's a 1 in there somehow. So for a 1 unit change in for a 1 unit change in beta, because that's the X, right? Let's be clear. So this is X and this is Y. So for 1 unit change in the beta, the expected return increases by the market risk premium. That's basically what this is saying. So it's saying that any asset, the required rate of return should be adjusted beyond the expected return for T-bills. It should be adjusted for each unit of the beta. It should be the market risk premium as a compensation for every unit of beta. Whatever the beta is for that firm. Now, I have something marked here because I have the beta of RF is 0 and the beta of RM, sorry, the beta of the returns to the market is 1. That's clear, right? I already mentioned that. Why is the beta of M1? What are we doing? What's a beta? When we plot RM and then some asset here, right? We do the returns to any firm. We did BCE before, for example. But now I'm saying, well, do it for the market portfolio. So essentially, you're just plotting the market portfolio by itself. So you're getting a slope of 1. It's the same data. It's going to be this is going to be a 1. Okay. So now this is the capital asset pricing model. It captures what I've been telling you for a while now, that investors need to be incentivized at a little extra to be prepared to take on that additional risk, but they want to be compensated by the market risk premium for every unit of sensitivity they have to market returns for that asset. All right, so let's apply the capital asset pricing model. And I'm going to show you how, what the implications are. So here we have 2 assets, A and B. And when you use the CAPM, usually you are given information on the risk and you use it to estimate the return. So here you have information on risk. And remember, we can calculate this, right? As long as we have returns to A and the returns to the market portfolio, we can calculate the slope. So that's what we're going to do, or estimate it. So this is for A, this is for B. So why don't you use the capital asset pricing model to estimate the expected return of each? I'll let you do that. Okay, how'd you do? What'd you get? So I'm going to take RF. So it's going to be the same formula each time. It's always going to be RF plus beta A. So I'm going to show you this. So it's the same numbers all the time. It's always going to be 0.04. All that's going to change is the beta. And then the market risk premium I'm going to put here as a calculation of 10%. All right, so it's always going to be, I accidentally pressed save. So it's always going to be in this format. All I change is the beta. So in this way, I'm just tracing through the line risk to return each time. I'm going risk to return. And I'm going to do it for A, risk to return, and for B, risk to return. That's what's going to happen. So beta A was 0.8. So it's going to be over here. I think I'm going to put a little bit further out because I know there's another one coming. So this would be it here. And then B is going to be 1.2. That's going to be over here. That's what's going to happen. So A is going to have an expected return smaller than M, and B is going to have an expected return bigger than M. And it's all because of the beta. So the beta is going to help us trace through. I'm going to put this here. Right? And that's what I have. So A is 12% and B is 16%. So I could actually mark them here. Where our F was 4, and ERM was 14. Okay, any questions, comments? What we're going to do now is combine those assets, A and B. Now, A and B are assets, but I could also create the return for A by mixing the risk-free and the market portfolio to get to A and create this level of risk and this level of return by doing so. Same thing with B. I could short sell T-bills and invest them towards, or put them towards the market portfolio and get B. So A and B could be assets on their own right, but they also could be created by combining risk-free and the risky assets of the market portfolio. So the SML is always a line, it's always linear. The capital market line was just for efficient portfolios, but the security market line is for any security and portfolio. Efficient or inefficient. If the beta is equal to 0, then that expected return will have the same return as the T-bills. If the beta is 1, then that expected return will have the same expected return as the market portfolio. So assets with similar risk will have the similar returns as other assets with the same risk. And we interpret that what we're doing with the capital asset pricing model is determining the expected return by considering how security I contributes to the average risk of the market portfolio. Let's look at combining asset A and asset B into a portfolio now. So we're going to resurrect our formulas for the expected return of a portfolio of 2 assets. We know that's a weighted average. So 60% invested in A and 40% invested in B would give us 13.6% return. So let's see. If you look here, mixing between A and B, it should lie somewhere between the two. If you have 40%, what was it, 40 and 60 or 60 and 40? So 60 of A and 40 of B should be closer to A than B. So it should probably be, it should be below M, which we find out it's 13.6, which makes sense because M is 14% return. So it's going to be here. Then once you find the expected return, you should be able to find the beta of that portfolio of A and B. You should be able to do find it using the capital asset pricing model, or, so this is the first time I tell you this, you can calculate it as a weighted beta. So just like the expected return is a weighted average, the beta of a portfolio is a weighted average as well. And so I get 0.96, which I expected to be less than 1 because it was more of A than B in the portfolio. So using that beta, usually to estimate the return, I use the risk, right? So I could also confirm my calculations by putting 0.96 in the capital asset pricing model and getting the same value, 13.6%. So all the assets are on the market line, security market line, A, B, and also P, the portfolio. All right, so that is that. I have several exercises that you can practice with. So I'm going to leave you to try those. What I want to do next is get into the UR case part 2. In the UR case part 2, Let me show you on the platform. I've been muted this whole time, Caitlin, for 10 minutes. Oh my gosh, I thought I unmuted it. Oh, did I just mute it now by accident? That's weird. Okay, so you heard everything? Oh, that's weird. Maybe I shut it off by accident. Okay, good. Thank you. So back to the UR case, rather than the 10% as the cost of capital, we are going to explore like 4 different alternative calculations of the cost of capital. Okay, and we're going to start with calculating the beta for UAir. We have some information here on UAir's returns, the S&P 500 during the years that the UAir destination or plan to fly to the Bahamas was being considered. And so we also have information here so that we can use the capital asset pricing model to compute the expected return from the beta. All right, so I give you all this information. It's all in UR case part 2. So you can follow along there, and I'll refer to the different, there's 4 different problems. I think there's more, 6, yeah. 6 different problems. And I actually, for number 5, I actually use 5.5 in the notes rather than 3.5. But you could do it for 3.5 as well. So to the notes. So we're going to solve the UR case first, and then I'm going to talk about moving from an all equity firm like the UR. We're just going to assume that it's financed solely by stock issue, and then we are going to consider if the firm issues debt and what we do about that situation. Okay. How many of you already watched the videos? Just curious. So I posted a bunch of videos. Okay, Julio. I hope this is adding value. Okay. Okay, so you see here, I have the capital asset pricing model, but I've put it with lowercase r. Hope that doesn't bother anybody, but I'm just moving towards understanding that this is just going to be like the rate of return, or R or I, that I used in the original formulas, but it's using the same sort of data that I used before with returns. And this is the formula for the beta. And what we're going to assume is that UAIR is all equity. Okay, it's financed only with stock. Here are the returns to UAIR stock over this period, like in the recent period. The decision was going to be made in 2011. So, or for 2011, so we're going to use previous years of market data. So what do we need to calculate the beta? We need the covariance and we need the variance of market returns. Okay, thank you, Sandra. So I calculate here. I begin with, oh no, wait, where did I go? Below is the calculation for the covariance and the variance. Here they are. So you could put this into your calculator, right? Because this is historical data. You can put these figures into your calculator and get this information. Let's do that together. So I'm going to enter the values. First, I clear the worksheet and I start entering 0.0491, enter down, and then 0.1, enter down, 0.1579, enter down, 0.3, enter down, 0.0549, enter down, 0.1, enter down, 0.37 negative, enter down, 0.55 negative, enter down, 0.2646, enter down, 0.4, enter down, 0.1506, enter down, 0.3, enter down. And then I get the statistics. There's 6 observations. This is the mean for X. X is the market return, right? S&P 500. This is the standard deviation for the market returns. And this is the mean for UAIR. This is standard deviation of UAIR returns. And then this is the A for the line. And this is the B. That is the beta right there. 1.55. And there's a correlation if we need it. I do want covariance. So to get the covariance for the beta, if I wanted it, I already have the beta, so I don't really need that. But if I wanted it, I would take correlation and multiply it by the 2 standard deviations, right? So that's how I get the beta, and I get those other returns, the average returns. And I did all the steps here if you're going to do this manually. So we have the beta. We need to put in to the CAPM to make the estimate. We need the market risk premium. So there's some different approaches I use here. So to get the expected, well, the market risk premium, I want the average historical market risk premium between 2005 and 2010. So what I do is I calculate the averages, which I did with my calculator. And for the market risk premium, it was 5.11. And for the risk-free rate, okay, so then I have to plug this in to get this. The average is 2.365. So then this is the historical market risk premium that I use here. I use the beta that I got, and then here I do something that maybe is confusing, but I decide to use the current risk-free rate as opposed to using the average risk-free rate. And that's because they differ. The current one is 1%. And the other is like double. So I'm going to go with the current one just so it's more relevant or most pertinent if I don't think that, so if I believe that it's going to stay low, then I'm going to use, so at that time, T-bill rates were pretty low by 2011. So we're going to stick with the low one. And then, so anyway, just follow directions. If I ask you to do things, just follow directions. But here I'm just arguing that you could do this in different ways, all right? And obviously you have to have logic. If you're going to choose one method over another or one set of assumptions over another, you have to have a rationale in doing so. So my rationale is that the T-bill rate has been falling, and I think that 1% is more reflective of what's coming in the future. So I stick with the 1%. So doing this calculation, I find that the cost of capital should be about 5.27. Now, how does that compare to what we were using before? So earlier, the cost of capital we were using was 10%. Now it's much smaller, so it's a lower required rate of return. How will that change things? Well, initially we accepted the UAIR project to the Bahamas, and we're still going to accept it, right? Because the required rate is low. And if you remember, the IRR that we calculated was 10.26. So it means that this is an estimated return on the investment, and it exceeds 10%. So if it exceeds 10, it's obviously going to exceed 5. So nothing's going to change in terms of pursuing the project or not. Let me say that before I continue. So nothing changes. We're going to continue. Continue to accept your project to the Bahamas. But what if we say, well, let's just make sure this is the right way to do this, since we have a whole lot of data. Why don't we use all of the data to calculate the average historical market risk premium? Why don't we, rather than using just current data? So if we were to do that, go back to the data on 1928 to 2010 in the risk and return notes, and there the T-bill rate on average was 3.7 and the common stock returns were 11.3, so the risk premium was 7.6%. So the average historical market risk premium over 80 years was 7.6, as opposed to the 2% that we had before. Leaving the current T-bill rate at 1%, look how high this is. This is really high. So you have to make an executive decision. What are you going to do? The numbers are very different. So you have to have a rationale. My rationale is that since these are very different, and this is a very high number, it exceeds the internal rate of return. for the project, and this makes it this makes it impossible that the project will be accepted. When these are different, the convention is to use the more current data for a more robust, reliable estimate of the cost of equity. So something more current. That's my rationale there. And it wouldn't have mattered if they were the same number, but they're so different. I have to choose and I have to explain why. Okay, so we've calculated that the cost of equity should be about 5.27. What if we have some other information and we want to use the dividend growth model instead? So this is also good because it might reinforce what we've been doing so far. I'm going to, okay, what's the dividend growth model? I assume that there's a constant level of growth in the dividends, right? And I assume that dividends are forever. So I'm using the variation on the growing perpetuity formula, or an application of the growing perpetuity formula to do that. So I need to find G. So with my assumption, I'm going to force it. I force it that there is a constant growth rate. There is not a constant growth rate, but I'm going to force it. I mean, it's not clearly steadily growing. But it's fine. We're going to force it. So let's see. I'm going to say from 2005 to 2011, there are 6 periods of G. So what I'm going to do is find out what G is, and I can solve for it as 3.78%. So that means if that's the constant growth rate, then from 2011 to 2012, next year, I expect there to be a dividend of 25, well, per share, 25.9472, or 26 cents per share. Then what I do, I have G, and I have C1, and I have given information on the price, I can find I. So this is an indirect way or a different way to get at the expected return for the firm. So rearranging like I do here, I put in everything that I have. Well, when you have the notes, I did clean the notes that this actually has 10.25 on it. Should like little typos. And you will get this number. Now this number looks more like the 5.27 number, so that's reassuring that we're on the right track. But we're going to stick with that. We're going to stick with the 5.27 number. We're going to assume the CAPM holds and stick with the 5.27 number. But this reassures us that it's a good choice. If we're prepared to think that approximately dividends will grow at a constant rate. So going to the UR project, these are the total project cash flows that we derived, where we assume UR is an all equity firm, and the Bahamas project has the same beta as the UAR's beta. Now that's not necessarily the case, and I didn't mention this before, but they could differ. Okay, it doesn't have to be the case that the betas are the same. So if we assume these two things, then we should pursue the UAR Bahamas project. I calculate NPV again, but I didn't have to because I know that the IRR was 10.26, so I know that this is going to be accepted. Then I ask you, what if we stuck with the 12.79% cost of equity? Well, I call it a cost of equity because it's an all equity firm, but I could also continue to call it cost of capital. So if it was 12.795, we would have rejected the project because the internal rate of return is only 10.26. So if we look back at the security market line, the UARES project is up here. For this level of risk, the required rate of return for UARE, which we calculated, was 5.27. But the UARE Bahamas project is all the way up here, so it would be attractive to invest in it. I've plotted everything on the SML like we see or no. I need to talk, before we go, I'm going to stop this example. I'm going to ask you to read the rest of this. I just want to go back to the SML. Yeah, you're going to have to look at this with the videos to finish these notes, but I will come back here next week and start with the equity. But what I want to do next week is be able to solve this last example, and I have provided you with a problem like this. What I want to talk about is out of equilibrium. When assets are out of equilibrium, like off the line, how do they adjust to the line? Because the argument is all assets fall on the SML, and the argument is because I could create all assets on the SML by combining the risk-free rate and the market portfolio. So because of that, all assets settle back on the line, and I'll explain why. Let me go back to these notes we were talking about, and I'm going to leave the rest of those for you to review with the video, the last video that'll be in them. Go back to this drawing here. So what if an asset is here? Let's call it asset J. Asset J has a beta. Let me erase this one. Of 1.4. For this beta of 1.4, for this level of risk, there's this expected return that's off the SML. Meanwhile, investors who have combined risk-free borrowing through the T-bill shorting and invested in the market portfolio would be here. Now they're going to catch wind of J, and what are they going to do? They're going to say, well, we're satisfied with this level of risk, but we want the higher return. So what they're going to do is offer money for J, and to get J, to buy J, asset J, they're going to offer higher and higher prices because the other investors are going to think the same thing, right? So as a result, they're going to bid up the price of J. So if we think about our basic perpetuity formula for risky assets or stock, I'm going to write this as like dividend and ERI. Basically, that's what I'm doing, okay? I'm using the perpetuity formula with the dividend that I'm going to get. I'm going to assume constant dividends. And I'm talking right now about the expected return and what's going to happen. So as the price for J increases, presuming that the constant dividend will continue, that means that the expected return must drop to balance this equation. So as a result, J will drop, and it'll drop just to be back on the line. This is an example of the risk, the equilibrium adjustment. That's how J is currently undervalued. So assets above the line are undervalued. Assets that are undervalued, investors will be attracted to and they will buy them and hold them. So they'll take what's called a long position. They're buy and hold assets. I'll say buy and hold to realize the increased price. What about below the line? I have a lot of stuff on this slide. What if we're here? And beta K is like 0.3 or something. So for this level of risk, investors are currently mixing. Investors who are prepared to take on that level of risk are mixing holding T-bills and the market risk premium to get this return. So anyone invested in K will do what? Coming to know about this or being aware of this, anyone invested in K will so anyone invested in anyone who saw J that was on the line was willing to was prepared to offer higher and higher prices to J to acquire it, and in effect they reduced its expected return. It was undervalued. But for K, the return is too low, so they want to get rid of it, right? They're going to try and sell K. As a result of selling K, what's going to happen? They're going to offer lower and lower prices for K. Offering lower and lower prices for K, and assuming the dividend stays constant, I'm going to put a bar on the dividend, even here. To keep that dividend constant, the expected return must rise. So you're going to require a higher level of return as the price drops simultaneously, and it'll get us back to the line. So this is another example of equilibrium adjustment. In the meantime, assets below the line are overvalued. The price must drop. So what investors should do when they identify overvalued securities is take a short position. What did we talk about earlier? You're going to short sell. You know the price will drop, so you're going to borrow it from your broker and then return it for the lower price later. So I have a number of examples for you where you are given information on the risk and return of assets. Assume the risk is correctly calculated and then estimate the return using the CAPM and check if you're on the line or not. If you're not on the line, then you have to, well, depending what you're being asked to do, you have to explain what action you would take if your asset is below the line where it should be. Then this is an overvalued asset and you should short. If it's above the line, it's an undervalued asset and you should long it. Any questions? Should I go back to the cost of equity for 5 minutes? So currently UAir is above the line. It should be pursued, all right? It's very attractive investment. So on this SML are assets, all classes of assets, all securities, and even projects should be on the line. Should I stop, Dylan? It's a lot of stuff. Should I stop here and let you guys work on that? And then, yeah, it is dense. And then we'll work on finishing cost of equity, but I'll start here next class, okay? So I'll put this video online. I'll put some exercises to practice, but watch the videos completely before I go to this part, because this is going to be, it's not hard, but you need to practice the other material, this material we discussed first. And then all I'm going to do is consider a firm that's not just all equity finance, that is also financed by debt. So I want to talk about how that changes our estimate of the cost of equity to the cost of capital, and in particular to the weighted average cost of capital. So next week we're going to talk about WACC, and I guess that's where I'm going to stop, because that will be the last class. So all we're going to do next class is talk about WACC and do some exercises together. But get ahead of me, okay? And work on those exercises already up there. Yes. Yes. And then the test is on the 23, and the test will be the final will just be on unit 5. And it's going to be by distance. And because unit 5 uses everything, so I'm comfortable with yes, it will be online, Darlene. Yeah, I hope that's good. I hope that's okay. But yeah, next class will be in Zoom. Okay. So next class will be in Zoom. I'll put the recording up and you guys just keep practicing. We're not going to get into unit 6. There's no time, and there's no time to make up time. So let's go with this. And let's be very serious about unit 5. You need to practice the Euro case. Yes. Any other questions? So we'll just work with the Unit 5 materials for the next 2 weeks, and this will be over. That's it. Okay, so have a good week and keep in touch. I'll put up some exercises for the assignment. And that's it. Good night. Nada. Bye.